Joining us now on the desk to add a little bit more clarity to some of the issues we've been experiencing in terms of investment strategy and, of course, portfolio management. Roger Williams from Centaur Asset Management. Thank you so much for joining us. Great to have you in studio. Little visibility, some would say. It seems that some are divided. Some would say we could see a default. Others think that things will be sorted out and there's going to be some resolution. But here we are stuck in Africa, in South Africa, and wondering how the global market is going to affect us.
Well, first of all, I think the materiality of Greece, I think people have to keep it in perspective. It's about 3% of the EU, and I think it's probable they're going to have to write off most of it, but really, it's not really that big a thing in the whole EU scheme of things. So I think a lot of the reaction's been over-dramatized, really. If you look at the facts, okay, it's 3% of the EU. If you look at Germany, their deficit currently is under 4%. I think France is about 5.5%. Italy's deficit's 4%. Whereas the USA is over 9%. Britain's also 9%. And I think the real risks are more in those countries than in Europe. I think it's really quite overblown.
How does this affect your asset allocation in South Africa? Does it actually make a dent in your thinking?
Yeah, listen, it hasn't really made a massive dent. I went tactically light in equities. I'm looking to increase it. I think the other factors at play here. First of all, in a debt deleveraging cycle, so economic growth worldwide is a lot slower than when they're leveraging up, and that applies to South Africa as well. And also then we've had rising oil prices. Now, oil prices went up about 50% to the quarter end, year on year to the end of March. And that takes money out of people's pockets worldwide. So I think that's another factor that's played into, a weaker economic environment. But I don't think we're seeing a train smash, and I think people must really invest within that environment. Things are going to be very slow. Look at the quality of the companies, whether they can produce, and really they have to reassess their portfolios, what's going to deliver. But I think some shares will still deliver in this environment.
But light on equities and cash, bonds, property?
I think tactically light. I'm not very negative on equities, but I think a lot of the shares won't perform. So you have to really look for the quality within the environment. So you have to be very, very critical and stock pick carefully. For example, I think Europe's actually an opportunity. You're looking at some reasonable quality shares, big shares there on 8-9% dividend yields, which is really unbelievable. It's unprecedented value out there. So I think that is actually an opportunity.
Do you agree with those statements, Mohammed?
No, I'm
opportunity.
I'm on the other side of that coin. I must be honest. I mean, when you look at Europe, my main concern with Europe, I take your point in terms of larger deficits and problems in other sovereign nations. But the thing that Europe doesn't have, that some of these other countries have, is fiscal cohesion. I mean, that's really been one of the critical points in terms of Europe being able to turn this around. It's something that they're discussing at this point in time. But I think in the absence of that fiscal cohesion, it's very different to, for example, the Fed, where in the United States, you've got all of your states as one fiscus at the end of the day, and in theory, they could actually print themselves out of this problem. The other problem in Europe, which is something I saw earlier today, is that you're starting to see depositors' withdrawals from banks, and if this effectively amounts to a light run on the banks, what ends up actually happening is that the ECB is really left with all of these sovereign exposures, and at the end of the day, those exposures at this point in time certainly looking very risky. So I'm pretty bearish on Europe specifically, and yes, I take your point again in terms of dividend yields being particularly high in Europe, but I'd be very nervous just given the macro outlook at this point in time.
So maybe you could tell us in terms of what you actually have, what exposure you've got to European shares, and how you've actually positioned yourself.
Yeah, listen, I'm being very cautious in this environment, but I'm targeting certain shares. So I've moved over the last 2 months, I've moved 11% of my fund offshore. I'm looking to increase that between 20 and 25%, and really trying to cherry pick the best opportunities, which when there's so much kind of, it looks apparent value, it's actually quite hard to cherry pick, because you want to find something under even a bad scenario can perform reasonably well. So one share I've bought is Vivendi. It's on about a 9% yield in cell phones and media, and a pretty consistent track record, and I think they just released the latest trading update, half-year results, and pretty consistent. So I think there's a lot of those opportunities in Europe, but you have to dig quite deep. If you want something high risk, I looked at Fiat recently. That's just it's consolidating Chrysler. It's about a 65 billion euro turnover company with a 3 billion market cap. So if they can get everything operating well, you could quite easily see 5 to 8 times in that share. So I mean, there's this kind of risk-reward ratio. I mean, it may not manifest in the next 6 months, but definitely a place to put some money.
Mohammed, would you agree that Fiat, Vivendi?
I
know you already said risk. Of course, we know what your thoughts are with regards to Europe, but value and value trap, we know that there's a play between the two.
I mean, my real position on this from an asset allocation perspective is that there are always going to be investors that have to have a long bias, for example, within their funds. And if you're going to be investing in equities, I agree with your methodology. Really dig deep, look for the value, look through the numbers.
Yeah.
I agree with your strategy in terms of moving some of those funds offshore earlier in the year. I mean, we saw a very strong rand. That was a nice opportunity. That being said, I'm still pretty cautious. My preference would be, park this in cash. We spoke earlier. I mean, you've seen U.S. Treasuries within the U.S. really getting very strong as a safe haven appeal. And gold has been kind of my real favorite play in terms of as an asset class, and maybe your view on that.
Because you've gotten it right. You've gotten it right, though. And those who didn't get in at the right level.
I agree. But I mean, just to give you an indication, as a rand investor on gold, not only 2 months ago, we were at 9,800 an ounce. You've seen 30% in 2 months. So as a pseudo currency play, gold looks quite attractive.
Roger, tell us, what is your play on with regards to gold? Is it part of your portfolio at this stage?
Gold isn't. The reason why it's very hard to evaluate. I mean, I think if you kind of look technically, I think it's still got a lot of legs. But to be honest, how much gold can you put in? You can't put 100% in gold. Maybe you put in 5-10%, because if the wheels come off, we saw in 1980 it raced up to 850, 900 and then collapsed. So how much? I mean, you can put in maybe 5%, but I mean, you need to spread your bets.
What is your favorite sector right now in South Africa?
That's hard. I mean, I've got a lot of stock picks. I don't really have a favorite sector. I mean, I've actually gravitated a bit more on a bottom-up basis. I've got quite a lot of financial services, but I've taken a very big position in RMI. I think it's a quality company at a reasonable valuation, and think it can perform.
Fantastic. We have to leave it there. Thank you so much, gentlemen, for joining me. Just very quickly, some news flow out from Reuters. Despite recent rumours, all agreed that Greece will remain part of the Eurozone. Of course, that highly anticipated phone call between Sarkozy, Merkel and Papandreou currently underway, and it seems that they are finding some way forward. So a bit of optimism there. That was Roger Williams from Centaur Asset Management. And of course, a big thank you to my co-host, Mohammed Nalla from Nedbank Capital, for joining me on the desk.